Hi, everybody. I'm calling this panel to order with the hope that it motivates people not to leave, but rather to take their seats. Well, those of you who are sitting, thank you so much. I am Dana Fisher. I am the new director of the Center for Environment, Community, and Equity here at American and a professor in the School of International Service. I am delighted to be able to be the moderator and help to encourage a discussion around this panel. Just for background, I'm a sociologist. I've been studying climate risk and climate disaster for, unfortunately, too many years now. And my new book, which is called Saving Ourselves from Climate Shocks to Climate Action, talks all about what was discussed in the last panel. And a lot of my new work is actually specifically focusing on how to develop more resilience within communities. And we're just kicking off a big project with AmeriCorps to help to develop civic capacity for resilience. So I am so thrilled to be able to moderate this specific panel, although the whole conference is fabulous, because we're here to talk about policy ideas around resilience. And so we have three wonderful speakers here. Each of them has been given the opportunity to talk for up to 10 minutes with slides as they wanted to. And then I have a couple questions to kick off the conversation, but then hopefully we'll have a lot of opportunity for people in the audience to speak up, and I will try to moderate that. So I will not stop anybody from talking until they reach 10 minutes, and then I'm going to be very friendly about encouraging you to end so we can move on. But without further ado, I'm going to first introduce Julie Shayu Woodard from Smart Home America, who's going to start.
Smart Home America is a nonprofit. Smart Home America is a nonprofit based in Mobile, Alabama. We came to be very similar to SBP. It was after Katrina. Louisiana, Mississippi got the brunt of Katrina, but South Mobile got hit as well. But we had just recovered 11 months prior from Hurricane Ivan, and a group of thought leaders said, we just built back and that got blown away again. So what are we doing with this rebuild the same way, rebuild the same way? What can we do different? So out of that spurred a group of individuals from the private sector, insurance, state government, and electeds to say, okay, we should probably think about this differently. So over the course of that time, we've thought about that differently. So basically a smart home, by the way, we were smart home way back when, before that was a thing. Which is why I'm going to have to spin it for you, right? Because it's not a Lexus. So basically a smart home, as I think maybe Francis said earlier, is it's a home that is built, and it can be a small business or a home that doesn't get blown away, doesn't get flooded. It has great insurance wrapped around it that's affordable so that it can recover after a disaster. It is energy efficient, and it can take rising heat or cold so that that family can afford to live there. And then, and only then, do we care if you wire it with all the smart gadgets, because if you spend the money for the smart gadgets, but you're replacing the home, it's not very smart. We have been doing this a very long time. Roy's going to be here tomorrow. Michael Newman is leaning against the wall back there. He's general counsel for IBHS, the Insurance Institute for Business and Home Safety. We walk hand in hand with them at the local and state level. Mike takes on the federal stuff. We cheer him on from the sidelines, but we sit at the table at the local and state level, and we work to put policies and codes in place that just make this stuff happen quietly in the background, because homeowners will not probably ever understand the complexity of insurance and building codes and what they live in. You'll see the big blob over the state of Alabama. We lead the nation in this construction standard. We also have some of the most affordable insurance rates in the Gulf of Mexico. That is because of all of the building blocks that we have put in place. So we have lots of those puzzle pieces that we've been putting in place since 2009, but we really worked hard over a 5-year period to flip our market. And when I say flip the market, it means that we have more carriers writing in our market at affordable rates. We have incentives in the market that help homeowners demand this at a local and state level so that they are choosing to want to do this. And then we have all those other pieces of the building blocks in place. So a lot of what we do at Smart Home now is support our partners and colleagues around the United States in replicating what we've done. So I think the biggest thing that I wanted to talk about really quickly is that I try to always be the positive person. So everything that was said on the first panel is all so very important and very true. And we live this at that local, state, and national level because we're in those conversations all the time because we're the ground game. What we know is that a homeowner will not make a decision unless you technically pay them. So that's a grant or an incentive or a reduction in insurance or something that's going to affect that affordability. When you can put those pieces of the puzzle in place so that they're happening automatically, that the homeowner doesn't really have to think about that, then it works and it goes much quicker. If you have the codes and policies at the state and local level in place, again, all of that's kind of in the background, then it's happening, but then all the people that touch that built structure have to understand that that's there and why it's important to their profit margin. And when they can understand why it's important to their profit margin, then they will sell that for you. Homeowners do not trust the insurance industry. They don't trust contractors and builders and roofers. They think all of that is crooked, but they trust their roofer, they trust their insurance agent, and they write a check to them. So we empower those people that homeowners write a check to. We don't ask them to understand what mitigation and resilience is. We just ask them to do something that's not going to break their book, that they're going to be able to make a profit, and that it's going to ultimately transform the community. And that's what we've done. There's grant programs across the Southeast. We and IBHS have had a hand in every single one of those except for South Carolina. That came to be without any of us, but we love South Carolina and walk closely with them in what they do with their grant program. These are some of the incentives that are in place for homeowners to make a decision to get a better roof. Roy will talk about all the programs at IBHS tomorrow, but the fortified roof program is one of the major keys to reducing risk on every property that gets one. And all the feds, finally, we will say, and I'm going to look over at Michael, I think we can say all the feds at this point get what fortified is, sort of, understand that it's really important, and they either should be asking for it as a minimum requirement, hello, anybody that works with HUD, or they need to be putting it out there that it is a very viable way of using that federal dollar because it's reducing the risk on that property. And that is it for me. Because I know we're going to talk a lot.
Yep, thank you so much. So I'm just going to pass the mic, theoretically, down to Mike Peterson from California Department of Insurance.
Thank you very much, and thanks, Julie, for those opening comments. You know, one of the great things about being in a Department of Insurance where you're an insurance regulator is you do get to work with all the insurance regulators from every state, and so you get to see some of these good programs in Alabama and in North Carolina in places where there's a strong incentive program already built in to reduce risk. So, you know, today I'm going to use my opening comments to talk mainly about like how do we maintain sustainable insurance, and good risk management is just a real cornerstone to doing that. And so during the time that I'm going to talk today, I'll spend the first part on home hardening for wildfire, but I'll end with wetlands, so it's a good pass off to my next panelist colleague here. But across the whole thing, I really want to drive home the point that, you know, one thing we're really trying to do as California's insurance regulator is to shift from insurance just being a mechanism to price insurance to being a mechanism that rewards risk reduction, and that can systemically reduce risk where we can and help policyholders maintain sustainable insurance and give them the information they need to be safer. So with that, I wanted to start off with just a little bit about my role at the department, because not everybody wakes up in the morning knowing what an insurance regulator does. We write the rules and enforce the rules of insurance in our state. We collect a lot of information, and we are very focused on insurance access for the consumers in our state. We've seen challenges that aren't just wildfire. It's very public, our significant wildfires of the last 5 years, but we've also seen atmospheric rivers, snowmelt flooding, and extreme heat events that cause a lot of different climate challenges for the state to, you know, work on reducing risk, and also opportunities for insurance to play a bigger role in the resilience for the state. I also just want to talk about our approach. So the way we've approached this problem is that we have gone to the consumers of our state to get as much information as possible by interacting with thousands of consumers in over 40 counties. California's a big state. There are a lot of questions that we get asked, but there's a huge effort to engage with the public and get the questions and concerns directly from them and figure out good policies moving forward to try to make insurance more available to them, help their lives in that way. But also structurally at the Department on Climate Change, we have created a climate insurance working group, which Alice mentioned earlier. Alice chairs the group. Carolyn Kuski is the vice chair. It's made up of 18 members that sort of bring together people who I think are really important to this conversation. Environmental groups who are worried about land management, wetlands, forest management, public policy experts on insurance who can look at examples from around the world and how they would apply to California. And then also some of our scientists that look at climate science and how it's integrated into insurance. And so from that working group, they started working in 2019 and over 2 years created 40 recommendations for my department and released those in 2021. And I just kind of want to walk you through the themes of those because I think it sets a good context for where I'll go next, which is to talk about home hardening and community mitigation. So those recommendations talked about the tributaries to what we call risk management. So how do you do better risk assessment? How do you communicate risk to communities in a broad, equitable way? How do you reduce the risks that we see? And then how do you transfer the risks? And by following that basic framework, which is not going to be a surprise to many of you, we've been able to advance successes in each of those categories. The state's developing a heat ranking system to help warn communities and better prepare communities for extreme heat events. We now have the ability for cross-jurisdictional collaboration through climate resilience districts that's authorized at the state level. And we have pilot project concepts that are out there looking at how do we close the insurance protection gap at a community level. But part of these recommendations is really how do you link together those last two parts of those risk tributaries, the risk reduction and the risk transfer. And the first panel brought this up very strongly, but I want to underscore it because these two areas of work have different histories. They have different funding mechanisms when it comes to risk reduction versus risk transfer. They have different data gathering mechanisms. They have different rules. There are different research pathways. And I want to underscore this because there's lots of people in the room who do research. You go to the people who do research on climate risk, and you go to the people who do research on resilience, and there's not necessarily crossover there, especially when it comes to insurance. And I think that's something that can change if we better stitch together risk reduction and risk transfer. So with that, I want to talk about wildfire in particular. And in California, it's no surprise to you that we've had substantial wildfires. What I do want to mention is that many of our most severe wildfires do get caused by embers that bring wildfire into a community. And so it's not necessarily what you might think of a marching fire towards you, but this ember cast that can be a long distance transmitter of fire into a community and then cause a catastrophe within a community that may not be expecting it. And so the way we've approached this is to say, okay, how do you adapt to this type of situation? How do you bridge together risk reduction and risk transfer? And I want to kind of tell you what our starting point was. In 2018, of all the insurance policyholders in the homeowners market, only 7% had access to any incentive to harden their home to wildfire. Now, we've had climate assessments, we're on our 5th right now, that come out about every 5 years, and each one of them have said that climate change is going to intensify wildfire. Yet in 2018, only 7% of policyholders had any incentive financially to reduce their risk. By 2022, that number had grown to 40%. And then by implementing regulations last fall, we will now be directing all insurers who rate a home based on wildfire risk to offer specific incentives for home hardening and community mitigation designations. And so that's the pathway that we're trying to accelerate, we're trying to get on to keep people safer and make sure it's more accessible. So how did we approach that piece? One of the challenges that was brought up in the first panel was that this ecosystem is built of a lot of different players. And so as a state agency, we convened all the other emergency management agencies so that there could be consensus on what are the 10 things that we really want homeowners to do. What are the couple things that we want communities to do? And I think that here the specificity is really important because it's very, in a general sense, risk reduction is great. But specifically for a homeowner, what is it that they spend money on? What is it that they look for grants on? What is it that they talk to their neighbors about? Those are really tangible questions that we wanted to be able to answer. And so we got together our Office of Emergency Services, our Department of Forestry and Fire Protection, which we call CAL FIRE. I do like Department of Forestry and Fire Protection better, but that's the way that goes. Our Governor's Office of Planning and Research does our long-term planning for the state, and our California Public Utilities Commission focuses on this wildfire safety as it relates to utilities. And so we brought them together, came up with a consensus list of 10 home hardening attributes that we could all agree on were the most important to prioritize, and that could be communicated clearly and consistently across the state. And we're both backed by science and achievable for policyholders. And so that seems to make them really practical things for homeowners to do. We announced that in early 2022. Then Insurance Commissioner Ricardo Lara, who's the insurance commissioner in California, started a regulatory process to require all insurers to reflect those actions in their rate filings for how you price insurance. And that process ended in October 2022. We're now in the process of implementing it. And so I think that this is a really good example of how you work with other agencies, align what you're going to focus on. That gives you a really strong communication portfolio for communities when you talk to homeowners, and then use the regulatory authority to make it statewide. So that is ongoing, and I think a major success for the department. Let me in my last minute, let me quickly pivot. Since I said I'd end on wetlands, I just want to make sure I do end there. So with wildfire and with our other perils, the community actions are essential and do bring some of the most risk reduction. And so our secondary area of focus has been on nature-based solutions. So what efforts can we make systematic and well incentivized throughout the state to invest in wetlands and forest management, marshes, sand dunes, the types of natural environments that reduce risk to consumers. And this is critical for flood because we only have a 2% uptake of flood insurance for our state, and we have substantial risk of flood. And so I'll just end there that we feel like we've made strong strides on linking together risk reduction and risk transfer when it comes to the structure of a home for wildfire. We're trying to expand into how communities can strategically use their resources to reduce risk. And I really appreciate the chance to speak.
Thank you so much. And last but certainly not least, we have Mark Glutney from Ducks Unlimited Canada.
Well,
Slide.
yeah. So good morning. It's a pleasure to be down here, and it's a different sort of audience for me to come and visit and talk to. Ducks Unlimited Canada is a conservation organization. We've been doing wetland restoration and conservation for 85 years, but 6.6 million acres in Canada. Our sister organizations across the continent, about 16 million acres of conservation over the last 85 years. So I'm going to talk about Nature Force. Nature Force is a partnership between 16 of the property and casualty insurance companies in Canada and Ducks Unlimited. And it's all about a bunch of the stuff we heard in the first panel. Francis talked about the need to reduce risk. This is about how do you set up and build resilient communities. Alice talked about nature-based solutions as part of setting the table and part of the solution to reducing that risk and part of our go forward needs. This project is about developing that knowledge and that understanding, and then driving that information out so that we can see more of these nature-based solutions on the landscape as a tool to effectively reduce risk. So, and Richard talked about the need for the insurance industry as a sector to catalyze change and to drive change. I think this is a good example of the insurance companies coming together and really thinking about how can we, as a sector, do things that are going to encourage change and encourage solutions that will reduce risk to communities, to individual homes. and how do we as this Nature Forest collective help drive that message out. So the intent of this Nature Force initiative is really to demonstrate that putting nature-based solutions, wetlands, riparian zones on the landscape is part of the way to reduce flood risk and to attenuate future risks of floods. It happened in an interesting way. One of our directors runs an insurance company, and he was bought out by Hub. So he spent some time talking with the CEO at Hub, and then he's passionate about wetland conservation. So the CEO, Tina Olson at Hub, and our CEO and this director, they sat down together and said, let's dream about a solution, and let's think about how could we, as a collective, a conservation organization and the insurance sector, do something out there that's going to be meaningful in terms of helping Canada build more resilient communities. And how can we sort of set the stage so that others see this benefit and then act accordingly? And by act accordingly, our thoughts was, how do we amplify that investment in these nature-based solutions so that we start to see big positive gains in replacement of a bunch of these wetlands and riparian areas that we've lost over the last 100 to 400 years, depending on where you are in the country. So that was the genesis of the idea. And Tina said, okay, I'm excited about this. I am going to go and convince my other CEOs in this sector that we should come together around this initiative. And she convinced 15 of her colleagues, and she's not done yet. Her goal is to get to 20 within this collective and bring them all together around this one banner and this one piece, really to demonstrate leadership in the sector. And she did it. She picked the phone up and she talked to her colleagues. They are all in at the same level. They're all funding for a 3-year agreement, and they're all equal partners with Ducks Unlimited on this project. And the project is, pretty simple in its nature. It's designed to go out and do 3 pilot studies across Canada in our 3 most populous provinces, one in Quebec, one in Ontario, and one in British Columbia. It's focused on actually delivering some of these nature-based solutions on the ground and then demonstrating the reduction in risk that will happen as a result of this, and then communicating and creating the awareness from this work. So from a programmatic perspective, we're working on 3 different watersheds. They range in size from the one in Ontario is 10 square miles. The one in Quebec's 40 square miles, so not super big. We were trying to get in the fringe of our urban centers. In Quebec, we were successful doing that. It's a peri-urban, rural watershed. Lots of partners working together on this, some really big opportunities to do some wetland restoration. We've leveraged substantive additional funding to do a bunch of the work, and we've built a collaborative of partners, both within provincial and municipal and federal governments, as well as within the research community and the local conservation community. So there's the groundswell around this one. The restoration work happens next year on a couple of the big wetlands. In Ontario, around our big urban centers, the land is so tied up by developers that it was cost prohibitive to be too close. So we're about an hour outside of Toronto in a rural landscape, but we've got 1 restored project underway and 4 more completed and 4 underway right now. And it's pretty simple. It's going in and working with the landowners and finding solutions that work on their ground. So the first project we did was on a dairy farm. So we helped them manage their subsurface drainage so that subsurface water wasn't just running into the river. It was going now through a series of holding areas and wetlands. We restored 3 wetlands on their property as well. And we're doing those kind of things that work within the context of the landowners. In British Columbia, it's a different situation. It's in Vancouver at the bottom of the Fraser River, a huge river, huge catchment. It's focused on sea level rise adaptation as well as working on living dikes and some foreshore elevation to try and reestablish coastal marshes. And then working with the First Nations communities, with the conservation communities, with the provincial and municipal governments, and the research and conservation communities to define a watershed where we'll do a bunch of this work and bringing everybody's focus to bear in one place. It's going to take that because, like Toronto, land costs are so prohibitive that it's hard to sort of get in and do the work. On a science perspective, we're basically building the hydrologic models around those watersheds and predicting, what consequences happen in terms of reduction of risk as we change the watershed, as we improve it by restoring these nature-based solutions. And then we've got the monitoring in place, which will validate the predictions of the models. And then really the intent of this whole exercise is really to catalyze investment by the broader community, by government, by industry, by many sectors in nature-based solutions. So we're using social media as a tool to get out there. We've got a website, thenatureforce.com. You can go and see what's going on there. We're coming to places like this to talk about the solution, trying to create the awareness, driving a lot of sort of messaging over time at the public. And as we have more and more projects coming online, we're going to see a ramping up of the social effort. I think one of the surprising pieces for us, as well as I think for the sector itself, the companies itself, has been the desire to engage their staff in this project. So we've created sort of opportunities for webinars where, we can accommodate up to 10,000 people in a webinar. We haven't certainly had that, but, all of the staff within all those companies that are involved are able to join in webinars talking about this project. We've also conducted a number of field tours where we've brought the staff out and showed them what they were doing, had them involved hands-on, planting some trees, helping with some riparian restoration. So that's been very important for the companies themselves in terms of selling the credibility of what they're investing in to their staff and to their communities. So to wrap up, I think this project demonstrates some pretty significant leadership on the part of the insurance industry. And ultimately, it's trying to catalyze large-scale investment in nature-based solutions that will mitigate risk over time.
Thank you so much, and thank you all for staying within the time allotted so we have lots of opportunity for conversation. I want to start with two questions I have for the panel, and then I'm going to open it up so everybody can think about that as I ask my questions. One of the questions has to do with the fact that we have this great diverse panel here that represents different stakeholder approaches, right? So we have more of the public-private partnership, we have the government approach, we have more of a private approach. And I was curious if everybody could just talk a little bit about your thoughts on using incentives to move forward responses to risk. And there's been a lot of conversation about this kind of, using carrots with getting people to respond in the ways that's necessary, incentivizing them rather than sticks in terms of dinging folks for not, mitigating risks in ways that are necessary. And I'm just curious if you have different approaches or different thoughts about that.
So we basically bring everybody to the table and figure out where their pain point is. When it comes to single-family residential or small businesses, it sounds cynical, but it is always the money, and it's affordability. So if they may think it's a really good idea, they may want to do that, but if they don't have resources or capital to do that, they just can't. So finding ways for the entire system, be it state, federal, or private, to help fund that. So tax breaks or grant programs or some product where there's a little bit of extra money on the front side but then you're going to recoup that money on the backside. So for us, it just comes down to really policies and pieces of company agreements to work with either their customers and finding an incentive within that customer base. Because if you have customers that are satisfied, you're still going to make a profit, right? But you're also reducing that risk at the same time. So for us, a lot of it is, and mandates are unfortunately pretty much a requirement when it's coming to insurance companies. We work with insurance companies every single day. And what we have learned and what I've learned in my 9 years is that the insurance industry is different in every state. They don't all talk to each other. They may all have the same name on their paycheck, but they don't know what everybody's doing. So we work specifically with the insurance industry as a whole in that state and figure out where they are, what they understand, what's their comfort zone. And then we work with them from that incentivization sort of scoping. And then we bring them to the table with everybody that's going to affect. And then we all just come to an agreement on where is everybody going to not be angry, and where is that success model going to move forward to, and then we really start it's really a lot of education. Incentives only work if everybody understands them and knows how to use them. And so that's a lot of where we've seen success in areas that we've worked in that zone.
I was just going to add, I think what's really tough about this question is sort of like, how do you reach the people you're trying to reach? As it was mentioned in the first panel, building codes are absolutely essential, but that's only going to affect the new buildings. There's a whole housing stock of existing buildings, and so how do you reach those people with the carrots or the sticks? And so at least from my perspective, in California, we have cities, we have counties, we have special districts, all that can offer ordinances or rules that are more of the stick of what you should or shouldn't do to reduce your risk. I think the opportunity for the insurance regulators, insurance sector is that it crosses all those boundaries. So there's one insurance commissioner for the entire state. And so when there's an incentive, it can be applied consistently to all sorts of existing homes without 56 different ordinances having to be passed. And so there is, I think, an opportunity for the carrots on that approach. That consistency does require the stick in terms of mandating that insurance companies offer consistently that same carrot. And then I think that, the piece that we still need to work on, which I'll, fully admit, is that to get to a whole alignment, statewide offices like mine need to be able to work with local agencies that are looking at rules, grant programs, incentives at the local level to make sure that each of these fits nicely with the same types of incentives for the same types of actions. I think that's what we're striving to do.
And I think an example for us is, we're working with the financial sector, and we're saying, you should think about giving preferential rates to those that are doing the right things as they're doing development. So as they're building out housing developments that are in the right areas, that have reduced risk of flooding, that maintain sort of natural infrastructure, they'll have lower risk over time. So it's probably a more sound investment on your part. So those are ones you should actually either invest preferentially in or provide the incentive by reducing the rate that you provide to them. Or the other part of it is a disincentive where if you don't do it that way, then you have a higher rate. And there's been quite a bit of traction with that with some of the financial institutions we've been talking about. So that's just an example of how we're influencing sort of the uptake of good build.
So I'm going to slightly disagree. And I actually disagreed a little bit with the first panel too. So yes, building codes affect new builds, but building codes affect every existing structure. So if you are in a wildfire zone and it burns to the ground and it comes back, yes, that's a new build. But if you don't have 100% loss and you do repairs or remodels, you need a building code that's going to make sure that those remodels and those efforts happen. I think the biggest thing is that Building codes also affect, when that insurance claim gets paid, how that structure comes back. So one of the reasons building codes are important is that, one, let's talk about the reality of insurance, right? There are going to be sectors of our communities that will probably never be able to afford insurance on their single-family residential home if they're lucky enough to actually own that home. Insurance is not going to become affordable anytime soon. It is consistently going up. We all talk about this morning about why, and that's not just going to fix itself in the next 3 to 5 years. So when we're looking at resiliency, and this is a lot of what we're doing in Louisiana in partnership with SBP, for every home that SBP re-roofed to a fortified standard and got a fortified roof on, many of those clients don't have homeowners insurance, and they're not going to get it anytime soon, especially with rising costs. But we saw after every storm in 20 and 21 and 22 that those homeowners were not displaced because SBP chose to do a different way of construction that's not required by code. It is now. We've been working on that for a long time, but it is now in Louisiana. But those 300 plus homes that had that fortified roof on, a lot of them, most of them in the lower Ninth Ward were not displaced per that hurricane. Hundreds of thousands of people are still displaced because of Laura, Ida, Zeta, Delta. So the building code does affect the existing structures we have. The science says that the roof, outside of, well, it is in wildfire too. The roof is the most important part of that structure. It is the first line of defense. Guess what's not in building code? Guess what's not been inspected in building code ever? The roof. Municipality lawyers cannot allow code officials to get on a ladder and look at a roof. And I come from local and state government my whole life. So code officials and I work closely together. They can't inspect a roof. And that's been the weakest link we've seen in the International Residential Code forever. Now, they took a big stand and IRC brought that roof in the 2018 code, but it still gave a jurisdiction the ability to have to choose it. It wasn't blanket. You had to decide you wanted to do that. Most jurisdictions did not. In the 2021 IRC, that roof is in there, very front and center. IBHS had a huge role in helping that conversation. So now that weakest link of the built structure, be it commercial, multifamily, or residential, is now in that IRC. And so, but what does IRC mean anyways? The International Residential Code, you can adopt it all day long. If you don't enforce it, it's just a really expensive stack of books. And so having the enforcement in place is even more important. So you cannot have resilient buildings if you don't have a code that supports that, because some jurisdictions won't let a builder do something outside the code. So if they want to do something better, some of them are restricting that. So it's very, very complicated, but codes are significantly important, even for the existing structures that we have now. Because when an insurance claim is filed, and God willing, that customer didn't force that insurance agent to take out all the little incentives so that their monthly ACH was more affordable, they have ordinance or law in there, which means that if that structure has to be brought up to code, that it's covered in that insurance. Okay, so do you want a 2006 code, or do you want the most current code that house is going to be brought to? So there's incentives are like, it's not simply, you can't just say incentives, right? There's so many incentives and there's so many layers to it, and it's all very complicatedly tied together.
Well, I want to ask one final question, which actually builds on a question that Mike shared originally, and I tweaked it somewhat based on the conversation before I open this up. Mark actually talked a little bit about communicating to the general public. And there are these questions about communicating risks related to wildfire, flood, other climate shocks, but also things like updated codes and other incentives and opportunities. So instead of just asking about risk, I would just want to give you all an opportunity to talk through how do you get the word out there about these different components of what you're doing? in a way that you find successful? You start with Mark and go backwards just to give you a chance to think.
Yeah, so I mean, yeah, that's a good question. And, you know, we're using all mechanisms, right? I mean, we've taken a broad scale approach. We think this is really important. So, you know, we're using social media. We're using, you know, a lot of dependence on some snazzy infographics that really try and sort of simplify the message so that it's visually easy to kind of understand. You know, they're complex sort of themes and ideas that we're trying to communicate. So you need to think about how to do it in such a way that the general public can get it, right? So that your grandmother will understand what you're talking about, or your 5-year-old. If you can communicate it at that, and that's a really important element. And you know, there are so many means out there of communicating now. You just have to kind of grab a bunch and roll them, and look for partners that are going to amplify the message. And yeah, it's just repetitive social media, social marketing. We also embedded a lot. We have a strong education program within our organization. So we embed it within our education program so that we're bringing it into schools at, you know, multiple touch points at multiple grades through the education system as well, as another way to get it into the household.
And I'll just add on to what Mark here said about the partnerships. I think that has been key for us is not only are we as a government agency a communicator, but it's who we can connect with that also communicates a similar risk reduction message. And I really, you know, I'm really passionate about this distinction of, I think that especially in research, we've put a lot of energy into how do you communicate risk. But there's also that it's not a footnote, it's a partner of how do you communicate risk and risk reduction, because that's, I think, what can help people be, you know, apply that information, be as safe as possible. And over the past 5 years, in California, we have a big state, lots of universities, we've been able to work with a number of them and come up with, you know, kind of ideas that you could apply at a neighborhood or community level. And I think that is really important. It's not just what can you do to your own property, but how do you work with the people around you? How does your local government communicate information to you? And how do we, you know, transition that research that happens at universities and IBHS to something that the public, you know, gets through multiple partners? So, thanks.
Got nothing.
Okay, well then I'm gonna open up the floor, and I'm just gonna ask you if you have a question to introduce yourself to, please. We'll start here.
Thanks for the question. I think it brings up the point that a lot of risk reduction is a multi-year challenge. You know, I think that there's two things I'd say in response to that. One is that by making sure that all insurers offer the same factors as discounts, then even if you move insurers, you sort of have a multi-year consistent, it's not necessarily going to be the same financial reward, but it's going to be the same category of reward. So that'd be the first point. That kind of bridges it to multi-year. The other part is that by working with the other state agencies, these same factors are going to trickle down through grant programs, through incentives, through you know, other agencies in our state, and some of those may be multi-year type of events. There are, you know, fire departments that help consolidate grants for roofs. That's the big ticket, right? Like we have in our list of things, there's vents that cost relatively little. There's clearing space, which can be economical, but the roof is a big item. And so those are the two ways that we're trying to get at that, is one, make sure that the same roof incentive, you know, will carry through multiple years, and the other is to make sure that we align with what grant programs are likely to provide funding for.
And I'll just back him up by saying that most carriers across the United States will give you as a homeowner a discount when you get a new roof, regardless of what that roof is. That new roof discount starts depreciating the moment you get that roof, and at year 5, that discount goes away. With the IBHS programs, because those programs are 100%, the research behind them, funded by the insurance industry, so the insurance industry understands the science and the data behind that, so they statistically know what their risk, the loss of risk reduction is. So the fortified roof and will be wildfire prepared, those discounts won't go away. They get re-inspected to make sure they're still standing at that standard, right? But the roof is literally the reason you get a replacement cost value or an actual cash value policy. It is the reason that when your roof is 15 days and at 15 years in a day, that you as a homeowner may not get a renewal from that insurance company. So the roof is the first thing an insurance company is looking for, is the age of it, the type of it, and what's on it when they're even pricing your insurance. So with the IBHS programs, when they're in place, and there's policy for that discount to be there, it is a discount that continues on and on. It's the one discount in the market when it comes to the structure that doesn't go away, but it's verified that it's still performing the way it's supposed to.
Thanks, Amy. I appreciate your question. So, what our regulation tries to accomplish is that for wildfire risk reduction at the community level, there's going to be a lot of variability from one neighborhood to another, from one community to another. There are also consistent actions that are likely to have an impact across those bounds. So our regulation recognizes two different designations that are available in California. One is quite popular nationwide, is the FireWise community designation. And so if you become a FireWise community, our regulation says that that has to be reflected in the insurance pricing for your policy. Now, the FireWise communities in some areas are doing different things than the FireWise communities in other areas, but they have enough of the same elements that provide some consistency, but also some local tailoring to what the risk is. And the key factor there is it's getting people together to make the risk lower in their community. The second community is a fire risk reduction community, which is something that our Board of Forestry at the state level, approves as a designation. And this is based on going above and beyond certain codes, ordinances, and standards. And so as those codes, ordinances, and standards move around a bit, this hopefully will reward communities that are going beyond that. But I think that you raise a really important point, that it is moving forward a major question of how do we provide communities more information on what are the common strategies and performance metrics for what they do, and how do we measure those, how do we share those with other communities, how do we make that a stronger incentive? It really is to implement consistency in that sort of climate adaptation strategy. I can't speak for every company. In my review of how companies operate in California, some were rewarding through pricing that one type of roof over another, others were not. Some were using it as an underwriting factor, others were not. And so there wasn't across the board consistency. And especially as the previous question said, this is a major investment. And so that consistency is important because you may shift insurers. And so that's where we felt that the consistency was necessary. And then it also sort of provides us the data categories to collect information moving forward and better refine what is the strength of that benefit to safety in that area.
And I will say that in Alabama, when those pieces of policies went in place to call for that discount, that only happened because the industry was at the table with our regulator saying, we are okay with this happening, because it doesn't happen if they're not okay with it happening. We have benchmarks in place, which means that there's a floor that insurance cannot go below, and they have to give that floor. If they want to go below that, they have to file a rate and show actuarially why it has to go below that floor. That we put in place because of consistency. The bigger insurance companies have those contracts with AIR and Aon and RMS, who's now bought out by somebody. So they can call and say, I need you to run the risk for this and tell me what actuarially I should be writing. And if I was going to give a discount, what should that discount be? The smaller mom and pops, which outnumber the captives like a lot, they don't have those contracts. And so basically the phone started ringing. Like, how do I do this? Regulation comes down, but it doesn't give the nitty-gritty details. And the smaller agencies needed to be told, if I'm going to give a discount on this fortified roof thing, what is it? And so we put all of that in place because of consistency. And we modified our building code so there wasn't a premium upcharge by a builder, because they price their bid on what's in the code. If it's not in the code, then as a builder, roofer, contractor, remodeler, they can upcharge you because that's a premium request because it's not required. And so that leveled the bids. And so that, a combination of that is why we're like at 43,000 structures now that have re-roofed or built to this, and they have affordable insurance, and they qualify for a good, robust package of insurance, right? So it's not just, I have to have insurance, let me get this actual cash value thing, so mortgage will leave me alone, but I'm not gonna get a check if I get blown away.
I think we're in the first chapter of that book because we just finalized the regulations October of 22. Insurance companies filed their rate filings April of 2023, and now those rate filings are being reviewed and approved. So we are in full speed mode of trying to communicate with consumers about what to expect. But this is going to be a long-term effort by the department, and I think it's a long-term research question of how do consumers understand these incentives? What do consumers who change insurers understand about the incentives? And some kind of measurement of that response. So yeah, it's a really interesting question.
So I keep saying that the sociologists need to solve the human behavior problem where they don't understand their risk and they don't understand what they're supposed to do, and then they don't make good decisions. Consumers don't read. And so even if you give them something, they just want to look for the bold lettering or the big box. So part of the consistency was that we saw the struggle, and where we have the same policies in states that don't have benchmarks is a drastic difference to where that benchmark is consistent. And you can hand the consumer one piece of paper, which is nice and colorful, that IBHS kindly prints, and it has what is that reduction in that premium going to be, so it's very clear to understand. They don't read the 5 years. They don't read that they have to get it inspected every 5 years, but they can divide by 3 in their head and know that the cost that they put into that roof, they're going to get back quick so they can still pay for ballet lessons and soccer fees.